Most people believe the hardest part of retirement is saving enough money. Ironically, for many people who have accumulated $500,000, $1 million, or more, the bigger challenge isn't building wealth anymore. It's turning that wealth into dependable income that supports the life they want to live. Because retirement changes the rules. While you're working, your paycheck covers your expenses, and your investments are primarily focused on long-term growth. But once you retire, your portfolio often becomes part of your paycheck. That changes everything. Today, we're going to walk through some of the retirement income strategies people with $500,000 or more in savings should consider. We'll cover what many retirees overlook, where unnecessary risks often appear, and how different income sources can work together. And if you'd like help creating an income, investment, and tax strategy tailored to your retirement goals, you can schedule a conversation with our team using the link below. We'd be happy to see whether we're a good fit. Let's start with the biggest mindset shift. Retirement isn't simply about earning the highest investment return. It's about creating sustainable cash flow. Think about it this way. Imagine two retirees. One has $1 million invested but no clear income strategy. The other has the same portfolio but understands exactly where every dollar of monthly income will come from, how taxes affect it, and how they'll adjust if markets become volatile. Who do you think is likely to feel more confident? Usually it's the second person. Not because they have more money, because they have a plan. That's why the first strategy is creating multiple income sources. Many retirees receive income from Social Security. Some may have pensions. Others rely on investment accounts. Some may also own annuities, rental properties, or other assets that generate cash flow. Rather than depending on one source alone, many retirement plans combine several sources so they can work together. The exact mix depends on each person's goals, tax situation, spending needs, and overall financial picture. The next strategy is thinking differently about withdrawals. Many people have heard of the 4% rule. While it provides a useful starting point for discussion, retirement isn't one size fits all. Markets don't deliver the same returns every year. People retire at different ages. Life expectancy varies. Spending changes over time. Healthcare costs can change unexpectedly. That's why many retirees benefit from having a withdrawal strategy that can adapt rather than relying on a fixed formula alone. One of the most overlooked challenges is something called sequence of returns risk. Here's a simple example. Suppose two retirees earn the exact same average investment return over 20 years. One experiences several strong years early in retirement. The other experiences several difficult years first. Even if their long-term averages are identical, the retiree facing losses while taking withdrawals may experience a very different outcome because they're selling investments after they've declined. The order of returns matters when income is being withdrawn. Understanding this concept often changes how people think about retirement planning. Which brings us to another important strategy: separating income planning from growth planning. Not every dollar necessarily has to accomplish the same job. Some assets may be intended to provide current income. Others may be positioned for long-term growth. Some may serve as reserves during periods of market volatility. Creating different buckets for different purposes is one approach some retirees explore to help organize their financial plan. Of course, every situation is different, which is why the appropriate strategy depends on individual circumstances. Another major consideration is taxes. This is where many retirement income plans either become more efficient or less efficient. The account you withdraw from first can affect how much tax you pay. Required minimum distributions may increase taxable income later in retirement. Social Security taxation can vary depending on other income sources. Large withdrawals from tax-deferred accounts may have broader tax implications. That's why retirement income planning often includes tax planning, not just investment planning. If you haven't recently reviewed how taxes fit into your retirement income strategy, this alone may be worth revisiting. By the way, this is exactly the type of planning we help clients with every day. If you'd like a second opinion on your current retirement income strategy, you can schedule a conversation using the link below. We'll discuss your income goals, investments, and tax considerations to determine whether there may be opportunities worth exploring. Now let's talk about flexibility. One of the biggest mistakes retirees make is assuming retirement will unfold exactly as planned. Life rarely works that way. Markets change, interest rates change, tax laws change, healthcare expenses change. Your priorities may even change. A retirement income strategy should be able to evolve as life evolves. That doesn't mean constantly changing investments. It means having a process for making thoughtful adjustments when circumstances change. Another strategy is reviewing risk differently than you did while working. Many people measure investment risk by portfolio performance. Retirees often need to think about another type of risk, income risk. Will your income continue if markets decline? Will your withdrawal strategy still make sense? Do you have enough flexibility if unexpected expenses arise? Those questions become increasingly important once employment income stops. Finally, remember that retirement planning isn't just about investments. It's about coordinating multiple moving pieces. Income, taxes, investments, healthcare, estate planning, Social Security, cash flow. Each decision affects the others. Looking at each piece individually may overlook opportunities or create unintended consequences. That's why many retirees find value in having an integrated retirement plan rather than viewing each financial decision separately. If you've accumulated $500,000 or more in retirement savings, you've worked hard to get here. The next step isn't simply hoping everything works out. It's making informed decisions about how those assets may support the retirement you envision. If you'd like to discuss your retirement income strategy and see how your investments, taxes, and income plan fit together, we'd be happy to have that conversation. You can schedule a call using the link below. Thanks for watching, and we'll see you in the next video.